Okay, good morning everyone and welcome to MACROACE with your host Tony. Going to go through a quick rundown of the Canadian employment data before we get it at the bottom of the hour. But hopefully everyone's doing well and enjoying their Friday. Let's get into it then. So what is the Canadian employment data? The employment change measures the change in new jobs being added, and that includes both full-time and part-time workers. And the unemployment rate measures the number of unemployed as a percentage of the labor force. And there's two surveys, just like the US, or similar to the US. You have the employment establishment survey, and then you have the household survey as well. Then that makes up the report. Now, how does it affect the markets? With a currency better than expected, data usually is favorable for the Canadian dollar. You see more of a bullish reaction. And for the bond market, for bond yields also see an appreciation as well. Again, it's the thought that the economy is doing well, and traders are less inclined to jump into the bond market. Hence, you have the government that then raises the yields and lowers the prices of those bonds to attract those investors. And then for the stock market, with better than expected data, it can be seen as bearish in this environment where the central bank, nobody's sure whether they actually finish with their hiking cycle or not. Although they did keep rates unchanged at their last meeting this week. But again, usually in this tightening environment, stocks see a bearish reaction if data is better than expected, because it leads to the central bank maybe wanting to tighten monetary policy further. But on the flip side, if you do get data that is worse than expected, then that plays into the hand of the stock market, because it means that the central bank doesn't have to do that much work to rein in any strong pressures that are affecting the economy. Carrying on to the previous report, what we've seen is that from the report itself, how many jobs were added in which areas. So in construction, there was a loss of 45k, or down 2.8%. Public administration, information, cultural recreation, transportation, and warehousing also saw declines as well in the report. Whereas on the flip side, you saw a rise in employment in healthcare, educational services, financing, insurance, real estate, rental, leasing, and agriculture as well. But overall, the data was negative. It did come in at minus 6.4k. So the figures were worse. So the figures worse than expected overall. Then looking to the next point as well, so on the unemployment rate increased by 0.1% to 5.5, which marked the third consecutive monthly increase. Then where is the economy at the moment now? So interest rates, as said, unchanged. The inflation rate at 3.3% compared to 2.8%. Average hourly earnings did tick up to 5% compared to the prior 3.9%. GDP quarter-on-quarter annualized was at minus 0.2% compared to Q1s of 3.1%. GDP month-on-month of minus 0.2% compared to 0.3%. The employment change, as said, came in as a negative at minus 6.4k compared to the prior 59.9k. And the unemployment rate, as said, at 5.5 compared to 5.4. And finally, the S&P manufacturing PMI was at 48.8 compared to 49. Then the triggers for the economic release. What are economists expecting for the release itself? So what they're looking at is the employment change. They're looking at a high estimate of 80k. Deviation would be, so ignore the 25k deviation there, but it'll be about a 60k deviation on the high end, and they're expecting a low estimate of minus 5k. The unemployment rate, they have a high estimate of 5.7% with a low of 5.4%. And then average hourly earnings is also going to be quite key to how the release, how the markets react to the release as well. Again, thinking about wage price pressures is quite important when it comes to the central bank's goal of trying to rein inflation in and then try to get the CPI data, or the headline CPI, back to the 2% target that the Bank of Canada is looking to get to. So the high estimate of 5.1% with a low of 3.4%. Then the sentiment and views and central banks, what are they saying as well? So you had on August 23rd, after, or nearly a month or about 3 weeks after the last report had come out on August 4th, he had CIBC that said softer jobs data points to lower 2024 rates, and the Bank of Canada is likely to place more weight on the weakening state of the labour market in its coming rate decisions, opening the door to cuts early next year. We'll talk about what Macklem's response was to all of those comments about a rate cut and when that would occur. But carrying on from this, you had Macklem said that it's too early to be thinking about rate cuts because we're not there yet. So because the Bank of Canada hasn't completed their task of bringing inflation back down to 2%, and that means that the central bank has more work to do or doesn't need to do any more rate hiking but keep rates where they are for maybe longer than what markets might be expecting. Macklem also said that as the labour market continues to come into a better place, that we expect wage growth will slow, and we'll be watching closely for evidence that confirms this rebalancing. So what you want to, as said, you want to be aware of not only the headline figure itself, the employment change data, or the employment change figure, but also what does the average hourly earnings look like too, because that can also muddle the market's perception of what the central bank might do. Let's say you get a very weak employment report, but then you get inflation, but then you get the wage price side of the inflation that ticks up much higher than expected, or higher than expected, particularly much higher than expected, then that could mean that there is more of a choppy reaction initially, as we had seen last time round. If you guys had looked at the deviations sheet, and then that means the job for policymakers becomes a bit more, although it's 1 month a bit of data, and they do say they are data dependent, it just makes it a bit more confusing as to what do you want to do. Do you want to bring down inflation but then also have the economy that then goes into then starts to stagnate and then becomes worse and then goes into a mini recession or a big recession? Or do you just make sure, or do you just kind of say that you are where you need to be with the rate being at 5%, and you will hope for in the future that data will then data over time will then be affected by the rates remaining quite high at 5%. So then investment bank views as well. So you had, if we're looking at the estimates then for the headline figure itself, so CIBC sees 13K, Scotiabank sees 35K, BMO sees 15K, and Bank of America sees 20K. So higher than what the, if we're looking at what the current forecast is for the employment data itself, it's if the median estimate of economists is at 20K. So Scotiabank with quite much higher expectations than what the other investment banks see. But then that means that this month could present data that could be quite strong or stronger than markets might be expecting. If you have if you have these dots of different investment banks, a couple of investment banks here and there that may be expecting a much higher figure than what the median estimate might be towards compared to their counterparts. Then if we look at the last market reaction, we'll be looking at the CAD yen, and you'll see that there was a choppy reaction. So this is about 5 seconds before that release had come out. But the reason why there was a choppy reaction is, one, you had the worse than expected data for the Canadian employment change, the headline figure. But then you had the average hourly earnings, which was higher than expected by 0.9%. The forecast for that back then was 4.1%. It came in at 5%. So that meant that you'll see it here. I'll show you here. So about 5 seconds to go, and you will see that there was a bit of a chop from the data. So the Canadian yen, CAD JPY. So there was a reaction from the we could take the reaction as from the Canadian dollar and how it reacted is one, you had average early earnings that ticked up much higher than expected. Okay, so there is the expectation that the central bank might have more work to do and might need to might raise rates again, or is a stronger firming of rates being on hold for longer and the chance of a rate cut being put off for longer. But two, then you had the other factors that the US data, albeit it wasn't that weak, it didn't really, it was more of a bland report because it didn't blow expectations. And you had the dollar that had a decline off of the back of that. Now remember, because the Canadian dollar, because you have the Canadian dollar that is dollar denominated, usually what happens is if one of the dollar denominated currencies experiences a lot of, let's say, downward movement or turbulence, you'd also see a similar effect happening to the other dollar denominated currencies as well. So when you're looking at the Canadian data with the US data, the reaction becomes a bit more skewed, actually becomes a bit more unclear as to what did move the Canadian dollar in that way, and why did it so. So in this instance, it was non-farm payrolls data that wasn't that strong, and the stock you had the stock indexes on the US side that had seen an appreciation. And average hourly earnings and average earnings in the US did tick up a little bit, but not for the year on year. There wasn't that much of a. They did tick up, but it wasn't too strong, where it blew it out of the water. So a mix of data caused confusion within the markets, and it was the Canadian dollar was mostly dominated by how the dollar was reacting itself first, and then of course you flip back to the Canadian data. The employment change data was much weaker than expected, so it did. So again, that was another thing to add as to why the Canadian dollar had seen weakness after that data had come out. So ideally, the best market conditions would be where you have the Canadian data by itself, rather than having to rely on, rather than having two sets of releases at the same time, like with non-farm and the Canadian employment data, because then it makes it harder to kind of determine which way you should go. But so we've got about a minute now till we get the release, or a minute and a half. But I want to quickly go through the deviations then and show you what had happened. So here we go. So you had about a 31k deviation, but then you'd seen this choppy market reaction. Again, that's because of what the US data was doing, because the US data was had come out at the same time as well. So it made the market reaction a bit harder to read. And because the data wasn't outstanding on the US side, then it meant that there was a bit more of a choppy reaction at the beginning. So what we need to be aware of with that, if the economists are looking at a 6k deviation for the Canadian data, and if that isn't met, then there is a possibility of not seeing a clear direction initially, and you might get a choppier reaction. So we've got less than a minute to go now, so let's get into it. But quickly before I go, about 31 seconds. But the biggest market reaction that we've usually seen from the markets has been from GBP CAD and CAD JPY. So let's get out of that here. Let's get our TICKSTRIKE running as well. Okay, 10 seconds. $39.9k, higher than the forecast of 20k, with the unemployment rate at 5.5%, higher, lower than the forecast of 5.6%. The Canadian capacity utilization 81.4%, lower than the forecast of 82.4%. Participation rate at 65.5%, lower than forecast of 65.6%, but the average hourly earnings jumping to 5.2%. 5.2%, so higher than forecast of 4.7%. So markets were expecting a decline in the average hourly earnings, but then you'd seen that jump that had occurred there. So let me get out of that. So that would be the main reason as to why you're seeing that strength in the Canadian dollar compared to the other currencies. Again, it's the wage price pressures that have appeared there. Okay, let's see. Okay. Yeah. All right. Okay. All right. So let's do some measurements then. Let's see what we've got here from the figures. So CAD JPY, let's say 30. There we go. That's what we want to see. It's about 14 and a half pips there. Okay. GP CAD. So to be honest, the market reaction wasn't huge. There's about 13 or 14 pips down on GP CAD. Euro CAD. Oops. Okay, 1 minute. Euro CAD. But you are still seeing that Canadian dollar strength. Okay, that's 16 pips down. All right, that's still going. All right, that's enough there. Okay, see how strong this momentum keeps going for. Let's bring over the dollar CAD too. Okay. Still, yeah. All right, that's about 14 pips down from there, from the release. So yeah, it looked like the market tried to get the jump on it, and if the data was, we can see that there, again, as said, you can see that the data was stronger than expected for the average hourly earnings. Hence, you'd got that market reaction. Although the rest of the data itself didn't really blow it out of the water. So the market's more or less relying on the average hourly earnings here rather than the headline figure itself. All right, so that basically concludes the live stream for MACROACE for the Canadian employment data. Hopefully you guys found that useful. Don't forget to like the video, subscribe to the channel, get the word out there if you found the information useful. But one thing I also wanted to kind of go through as well with you guys is with the FinancialJuice and what it is. It's a live voice and text service. So if you're a day trader and you're wanting to keep an eye out on what the markets are doing, and what news is moving the markets, then having a live voice and text service does exactly that. So think of it this way. News always moves the markets, and then you're down to your technicals. But there's also the other things that we've got to be aware of is that you have the big boys who use that fundamental news, what they see, to make those decisions to capitalize on potential trades, manage their risk, of what's going on in the markets, or what's being said globally. Maybe it's Fed's Powell that's come out with a surprise speech, or it's Fitch Ratings that has said something about the US's rating go from AAA to AA instead, and then, or it could be anything that could have an effect on the market. Those are things that those are things that traders need to be aware of, because then that will then have an effect on what the markets will do. Maybe it's then markets start to price in and speculate on where the central bank might go, whether the Fed might continue raising rates or maybe hold for longer than what market participants were originally thinking. So that's why it's quite important to have a live voice and text service. So here's what I'm showing you here on the FinancialJuice newsfeed. You have your live voice here, which I've just clicked that on there, which is in real time. There's no delay to that. Here you have your newsfeed as well of the text headlines. On the left-hand side, you have the economic calendar as well, which gives you, of course, a week ahead or preview what to expect. And also the data is in live real time as well. So there's also that too, being able to see that data there, lickety split quick as well. Now, one of the things that we have as a feature as well, we have a need to know market risk. So it's basically representing the bits of news that would be important for traders to keep to know about, to manage their risk for the rest of the session, and also to know what's happened. But basically, it's to tell you what's happened in the session, or what you could expect in if there is a headline that's put in there that could have an effect on the markets during your trading day. So that's FinancialJuice, and if you wanted to have a little play with the with FinancialJuice, then you can sign up for the free version of FinancialJuice, which we call the light version. That's the link there for you, and I'll pin that there for you. So the light version of FinancialJuice, what it allows you to do. The live version of FinancialJuice, there is a delay to the feed, and there are adverts that are played, and as I said, there are advert banners that appear as well. That's the live version. The pro version, it's in real time. There are no delays to the live voice or text feed or economic data. Okay, and you also have the option to chat to our news desk as well. You can see the icon in the bottom right hand corner there. You can also chat to the news desk to ask why the markets are moving in a certain direction. Has there been a bit of news that has changed sentiment or the markets direction? So that is all. So that, as said, if you're unsure of what a live voice or text service is like and how it's run, and then how you can utilize that in your own trading, that again, as said, you can have a little play with and see how that kind of works for you. If you do want to go to the pro version of FinancialJuice, make sure you've made an account first on the on FinancialJuice and then you've verified your account from your email. Once you've done that, go back, and then if you do want to subscribe to the Pro version of FinancialJuice, there'll be a button where you can see the FinancialJuice Pro button, Pro bit here, the logo. It'll say Go Pro in the top left-hand corner of the newsfeed. Click on that, select your subscription, and then you'll be able to see and then be able to select which subscription that you want. Once you've done that, then log out and then log back in to your account, and then you'll have the Pro version to the FinancialJuice newsfeed, and then you'll be able to see what I'm seeing here. Okay. Again, as said, the live version of FinancialJuice is you have a real-time voice and text service with the economic data here at the same time as well, all in one place. So that's FinancialJuice Pro. Then we have TICKSTRIKE here. So what does TICKSTRIKE do? If you're unsure of what it does, TICKSTRIKE allows you to listen into order flow within the markets. Okay. So what I mean by that, or another way to kind of think of it, is that it shows you how strong the buying or selling momentum is. Okay, so it gives you a visual alert. You can see here with the red bar that it's showing me here, and the red figure. And it also gives you an audio alert too. So you guys can't hear this at the moment, but on here, each time that there is a change in the volume, you can see here, then it'll give you like a little sound alert to whatever you want it to, whatever you select it, and whatever you want it to be. Okay, so let me explain the numbers. So you have a range of sensitivity. 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that's going on here and there, then TICKSTRIKE, as you can see, will pop off for you and give you that visual audio alert. If you drag this slider here on the ticker box, this goes all the way 15. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling compared to what it does at the time, then TICKSTRIKE will give you a visual and audio alert. So you can see here, comparison, these tickers are set on level 1, the most sensitive, and this is on 15, the least sensitive. You can see this is the tickers here are going off much more than this ticker here, because it hasn't reached the level 15 to say, yep, there is this much volatility, or it's reached the level of volatility here that you can see. Then another feature that we brought out, so particularly if you're scalping the markets, right? This is for the scalp boys. But so this lightning bolt here is even more sensitive to the market reactions. And what I mean by that is, so you had level 1, which is the most sensitive to market reactions. Okay. And then if you click on the lightning bolt, you will have another 15 levels below 1. So you're going to minus 15, okay? And going all the way, or you're going 15 levels below 1. If you pull this slider all the way to 1 again, it's super sensitive to the market reactions that are occurring within the market. So again, as I said, if you're scalping the markets, it's more made for you guys there that way. But as I said, it's a tool to understand and to use to manage your risk, capitalize on potential trades that are occurring within the markets, and then be able to use that however you want to use it. Now, there is a 7-day free trial of TICKSTRIKE, which you guys can have a little play with. Oops. There we go. So there we go. There is the link there. So TICKSTRIKE, there is a 7-day free trial to have a little play with it, see how it works for you, and have a look and see whether it's for you. If you are comfortable with going with a pro version, or going with a full version, or should I say continuous subscription, I said that's totally down to you. See what you feel like you want to do with it. But of course, there is also the free version here on the FinancialJuice newsfeed, which you have this little bit here. Okay, but the only thing with this is it's limited to the 4 different asset classes, and you can't really go delve deeper into those. You can't look at the Nasdaq or the Dow. You're limited to the S&P, Euro dollar, oil, and Bitcoin. Also, the sensitivity is restricted as well, so you can't chop and change that. But if you want to get an idea of how TICKSTRIKE works and then try and implement it into your trading strategy, then probably best to start off with the free version if that's what you would feel more comfortable doing before you go to the pro version of TICKSTRIKE. Okay, so that is TICKSTRIKE there. The markets there, the market reaction is there. That's, I'm not going to go into this anymore. I've done my bit. All right. So one final thing as well. So for the deviations of the economic release, we've had people saying, "Is it free? Where is it? Can I get it? How do I get it?" All you've got to do for the deviations sheet that I showed you, I'll bring it up again. All you've got to do is subscribe to the MACROACE mailing list, and then on the Monday, you'll get an email with access to the deviations Google sheet that I have here. So let me bring that up for you guys again. Right, here we go. So the deviations sheet, let me walk you through it as to how it works and what are the ways that some people have used it or can use it. Now, the deviations sheet basically shows you how much the markets react to different economic data. Okay, and also for the interest rates, you get maybe there is a comment that's been made that is also added there to give you a reminder or to tell you this is what caused the market reaction. But let me bring up the Canadian employment change data from the past. So again, as I said, so you can look at this in a live version. Of course, so here you can see what the market reaction was the last time round, and this bit here shows you the initial market reaction going to the wick of the candle on a 1 minute chart, and then this figure in the brackets. This figure in the brackets shows you the market reaction 10 minutes after the release has come out, or how strong it's been. Usually, if there isn't, so some of you might be confused as to what this figure means here. Did it go up or down? So if there is no extra word, if there is no word here in this bracket, so if the initial market reaction was down, if the market reversed, then I would put in here up 9.4 pips. But if it didn't, and it was still below where it was from the release, then you wouldn't see any extra words, basically. And then one of the things I'm going to be doing is adding in where were the markets 30 minutes after the release into the deviations as well, into this Google sheet that you can see. But again, as I said, this is completely free. A lot of people use it to, well, one of the ways you can use it is to, of course, understand how the market's reacted in the past, and then make your own judgment as to what deviation or how big of a deviation you'd expect from the markets to then be able to make an actionable trade or to add to your strategy, or to change your strategy. Okay, and then of course, or other way people can see it is they just take it as in data, or put all the data together. As actually James, or from a team, has put the data together for the non-farm payrolls release, and then put in a nice little infographic for people to have a look at to see what was the market reaction like overall, depending on what the deviation was. So that's what, again, research, use it for your trading strategy. Of course, it's, if the market reaction was such and such, doesn't mean it's going to be the same thing again. But you have an idea, a better sense as to what to kind of expect to a degree. So that's the deviations. As I said, completely free, and the link is in the chat for you there. And then finally, if you like trading high probability stocks, futures, FX, and crypto breakouts in real time, then subscribe to Unusual Activity, and you'll be able to have access to that, and they'll be able to trade those be able to use those the indicators, or you'll be able to use the indicators of what the software does to be able to see which market is seeing a bigger amount of volatility than it usually does at the time, right? And and it will alert you to that breakout there. So for example, let's say on Apple, let's say that there is an unusually high amount of volatility that has appeared, and you see a lot of let's say there's a big amount of buying or selling that is going on with Apple. Then what Unusual Activity will do is it will give you an alert to say, okay, Apple is seeing more volatility and strength than it usually does in a usual trading day at this time. So that's also quite useful to look at as well. All right, ladies and gents, thank you very much for tuning in to MACROACE. Next week we have the ECB rate decision to cover. Economists, let's have a look here. So a lot of economists in the past, they were expecting the ECB isn't going to raise rates at the next meeting, but now the sentiment seems to be shifting to it might do it at this meeting rather than a later meeting if they were going to raise rates. So next week we'll be covering the ECB in a bit more detail. Again, same thing what I did here, the sentiment, what have central bankers said in the past, and what to be aware of, and how the markets reacted to what the ECB had done last time around. Okay, thank you very much, ladies and gents. I will see you guys next time.